And now we think that we're in the beginning of the next upward phase that's likely to take gold prices to record prices high, far above $2,000, which is the peak that we saw last August. We think that gold prices have a lot further to run in the long term. On a short term, we saw that price spike up to $2,000 in August of 2020, and the price has come off and has been consolidating. Our expectation is that the consolidation will probably continue through most of 2022, but that at some point we will stop that consolidation phase and move into another round of increasing prices for gold and silver as investors become more concerned about the political and economic and financial uncertainties that they are facing personally. Right now, we're looking at interest rates. We're looking at currencies and alternative assets and investors' interest in gold and silver as portfolio diversifiers and assets. Inflation has become more important as a topic that people are studying, and we're doing a lot of work on there. We are of the view that most of the inflationary pressures we're seeing in 2021 are in fact transitory, and that by the second and third quarters of 2022, inflation will no longer be an issue in the financial markets. People will be pivoting back toward employment, unemployment, and possibly even deflationary pressures on the longer run, which is something that we see. I think gold also plays a big role as a safe haven. And one of the themes that we've seen emerge really over the last 10, 12 months now is the increased interest in gold and silver due to political problems. Domestic political problems in the United States, China, parts of Europe, the fact that the UK is now Brexited. And what does that mean, A, for the UK economy, and B, for the countries remaining in the EU? Russia is an issue. So we're looking at domestic political problems. We're also looking at international political problems, the tensions between China and the United States, China and Canada, China and Europe, China and Russia too, truth be told. You don't hear about that a lot in the West, but there are some tensions there. So we're looking at increased role of political issues and political uncertainties leading investors to buying gold and silver. Our view is that it has much further to run in the longer term. I mean, when we talk about the bull market that we're watching, we're talking about a long-term bull market that we believe began in 2000, 2001, and had an intermediate peak in 2011. We saw consolidation at higher levels from 2011 to 2019. And now we think that we're in the beginning of the next upward phase that's likely to take gold prices to record prices high, far above $2,000, which is the peak that we saw last August. We think that gold prices have a lot further to run in the long term. On a short term, we saw that price spike up to $2,000 in August of 2020, and the price has come off and has been consolidating. Our expectation is that the consolidation will probably continue through most of 2022, but that at some point we will stop that consolidation phase and move into another round of increasing prices for gold and silver as investors become more concerned about the political and economic and financial uncertainties that they are facing personally and that the world's facing. Right. Again, it's pretty much the same. And when I was talking about the factors that we're looking at right now at present, I left off the commodities and gold as a commodity. And I think that you have to pay attention to that because the gold market is relatively tight right now. There is a lot of metal in inventories, but historically that has not precluded higher prices. And one of the interesting things about gold is investors as a group tend not to sell it, which means that when other investors want more gold because they're concerned about the economy or the political environment or their bank stability, when investors want to buy more gold, they have to buy it from newly refined supply because there aren't that many investors who sell their gold when they're bearish or when they're bullish. And it's an interesting characteristic of the gold market. Now, Going forward into 2023, 2025, we look at the deficit spending, not only in the United States government, but around the world. There is sovereign deficit spending and growing sovereign debt. And that is a problem that sucks money out of more productive investments. And it's going to continue to be a problem, and it leads to that debt. So it's deficits and debt, not just public, but also private. We have, as a world, we have loaded up on debt. And you see that in the Chinese real estate market right now, but there are similar conditions around the world in the private debt markets. So those are real big issues. We think that the Fed has a lot of ammunition to handle it, but going forward, we look for the consequences of the next recession. And our expectation is that we might see a recession by 2023, 2024. If that happens, then you start having more stringencies in the debt market, and you start seeing greater currency volatility, and you could see investors move from buying around 40 million ounces of gold this year and last year to buying maybe 50 million ounces of gold. And given the fact that those people who own gold in above ground refined inventories tend not to sell, that increase, a 25% increase in investment demand would be reflected in sharply higher prices. Commentators who are looking for drastically higher prices suffer from a lack of understanding about the gold market. As I said, investors as a group tend not to sell gold in periods of rising prices, but individual investors do. So if you go back to 2013 or so, you saw, say, maybe 40 million ounces of net investment demand for physical gold, but you saw perhaps 120 million ounces of gross investment demand, because you had about 80 million ounces of investors selling gold. And you don't see that because the gold market's extremely secretive and private. There's no volume data the way there is in stocks and bonds and currency markets, away from the futures and options markets. So you don't necessarily see it. And the reality of the gold market is that, yes, you have about 2 billion ounces of gold that's owned by private investors. You have another billion ounces of gold that's owned by central banks. And that metal in the past it hasn't stopped the price from going to $850 in 1980, or $1,900 in 2011, or $2,000 last year. But it has stopped the price from going higher, because when you get to these extremely high levels, roughly speaking, about $800 an ounce in 2020 dollar terms, when you see gold prices rise that sharply, two things happen. One is there are investors who say, I want to take profits here, and they do sell. And the other thing is that the gold price usually spikes higher because of economic or political or financial market instabilities. It could be high inflation. It could be American hostages in Iran, a quadrupling of oil prices, which is what we saw in 1979. And again, in the period, say 2004 to 2011, actually, that was more like a 15-fold increase in oil prices if you start with $10 a barrel in 2000. So you start to see two things. One is that those economic and political and financial market factors that are driving investors into gold start to dissipate or correct. And the economic environment changes so that investors say, okay, gold may be peaking. And as they're saying that, they decide to take profits.